The closing bell has just sounded on Wall Street, and we're wrapping up what turned into a quietly constructive Monday session. I'm Grant Mercer. This is Storm Stock Solutions, and we're here to bring some clarity through the chaos of today's markets. We don't have index prints in front of us in this feed, but the story of the day is pretty clear. A calmer bond market, a bid into certain defense and AI names, and a retail investor backdrop that's very focused on personal finance and planning as we head into year-end. Let's start with the upside leaders. According to reporting from MarketWatch's Victor Reclatus, shares of Huntington Ingalls Industries, the military shipbuilder, soared to fresh record highs after the U.S. Navy selected the company to design and build a new class of small warship. That follows a rally that started Friday when the contract news first hit. This is a textbook example of how a single, high-visibility government award can re-rate a stock and shine a spotlight on the broader defense complex. Traders will be asking whether this is a one-off pop or part of a longer trend tied to elevated defense spending and shifting geopolitical priorities. Another positive theme came from the rates market. Joseph Adinolfi at MarketWatch highlighted that a closely watched gauge of bond market volatility has dropped to levels that many on the street interpret as an all-clear for equities. After a stretch where every backup in yields rattled stocks, a quieter bond tape gives investors permission to focus more on fundamentals and less on macro shockwaves. That calmer backdrop likely helped support risk assets into the close, even if price action on the major indices remained measured rather than euphoric. On the downside and risk side, we don't have a single smoking gun sector in this data dump, but there are a few undercurrents to flag. One is the US dollar. Vivian Liu Chen notes that the dollar, which has had a very rough 2025, is now flashing a technical golden cross, a shorter high-term moving average pushing above a longer-term one. If that move higher and the dollar continues into 2026, it can be a headwind for commodities and for large-cap multinationals that rely on overseas earnings. It's not a panic signal, but it's a reminder that FX trends can quietly rearrange the leaderboard under the surface. There's also a lot of attention on what I'd call household-level risk management, rather than pure market risk. Several of the most read stories today aren't about tickers. They're about decisions. Quentin Fottrell's columns on retirement readiness and estate planning are getting heavy engagement. Questions like, we're in our 60s with $1.5 million in IRAs? Can we retire next year? And how do we split an estate fairly between children in a blended family? That speaks to an audience that's acutely aware of longevity risk, tax risk, and family dynamics, even if they're not trading every headline. In the same vein, there's a piece on whether to gift a house to a daughter at a bargain price after it's appreciated by $500,000. That pulls in issues around capital gains, gift taxes, and the desire to give younger generations a head start. And Charles Passey's look at why winning a $1 billion, $6 billion ball jackpot won't actually make you a billionaire once taxes and other frictions are factored in, is another reminder of how big numbers get whittled down in the real world. None of these are direct stock catalysts, but they shape how individuals think about wealth, risk, and liquidity, which ultimately feeds into retail market behavior. On the sleepers to watch list from today, I'd put two themes. First, the AI infrastructure story. Christine G. at MarketWatch reports on Alphabet's roughly $4.75 billion deal to acquire Intersect, a data center partner, as part of the scramble to secure reliable power for AI workload. Energy availability is emerging as a real bottleneck for AI expansion. Traders and longer-term investors alike are watching to see how moves like this ripple into utilities, data center rates, and chip and cloud names that depend on high-density compute. Second, year-end tax positioning. Andrew Keshner's piece on tax moves that can lower your bill and potentially boost your refund underscores the seasonal pattern where investors harvest losses, realize gains, and reposition portfolios ahead of a new tax year. It's not flashy, but it can help explain some of the lagged December flows you see in winners and laggards, even absent big news. So how does this set us up for tomorrow? If the bond volatility all clear holds overnight, the path of least resistance remains a grind higher, or at least a stable tape, with pockets of outperformance in defense, AI infrastructure, and potentially retro-sensitive areas that benefit from calmer yields. On the flip side, any abrupt move in the dollar or a surprise macro headline could test that calm in a hurry. For Tuesday's open, I'll be watching whether Huntington Ingalls and the broader defense group can build on today's breakout, how hay-linked names respond as the Intersect deal gets digested further, and whether we start to see more pronounced your hen tax and window dressing flows in the usual suspects, the big winners and the deep laggards of 2025. We'll break all of that down for you in our next pre-open report. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady,